Good morning, ladies and gentlemen. Welcome to Shaily Engineering Plastics Limited Q3 and 9M FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Sanghvi, Managing Director, Shaily Engineering Plastics Limited. Thank you, and over to you, sir.
Thank you very much. Good morning and a very warm welcome to all the participants to the post-results earnings call of Shaily Engineering Plastics. I have with me Mr. Sanjay Shah, our Chief Strategy Officer, and SGA, our Investor Relations Advisors. I hope you've had a look at our investor presentation that is uploaded on our website as well as the stock exchange. Despite the challenging environment, we have registered sales of 446 crores in the 9 months of FY23. As you're all aware, we are an export-oriented company with customer base primarily in Europe and North America. And given the current economic conditions, high inflation, and the customer sentiments in these markets, we have seen substantial reduction in offtake over the last 2 quarters. We also expect this volatility to continue for the next 2 quarters. On the EBITDA front, margin was impacted due to slower offtake, which has impacted in lower utilization levels, leading to lower absorption of fixed costs. As utilization levels improve and raw material prices stabilize, we expect improvement in margins. We are working very closely with our customers to ensure optimal production, increase in offtake, and ensuring optimal inventory levels. We continue to watch the situation very closely. Our focus is purely on adding customers and markets in segments where we are present in order to increase our utilization levels and sweat the asset base that we have invested and created over the last 3 to 4 years. Shaily is known for precision, quality, compliance, and our engineering capabilities. We want to focus on business segments, both existing and new, where this is a must-have. We see good opportunities in consumer electronics, telecom, and other healthcare segments apart from drug delivery. We will use the existing infrastructure to a large extent and only invest in critical capabilities that these segments need, and work towards building a business model where we are married to the customer. I will certainly provide more updates as this evolves and we see traction. As a last note, I would again like to emphasize that we will be very careful and prudent with any future investments and only do so when there is an absolute need. That is all from my side. I shall now hand over the call to Sanjay Shah, Chief Strategy Officer, to give you the operating and financial highlights. Thank you very much.
Thank you, Amit. Good morning, everyone. I shall share with you the highlights of our operational and financial performance of Q3 and 9 months FY23, following which we will be happy to respond to your queries. During the quarter, we processed 4,121 tons of polymers as against 5,321 tons in Q3 FY22. For 9 months, we processed 16,026 tons of polymers as against 13,912 tons in 9 months FY22, an increase of 15% year-on-year. Machine utilization rate was 38% in Q3 FY23 and 45% for 9 months FY23. Exports during 9 months FY23 stood at 77% of total revenue as compared to 78.7% in 9 months FY22. Exports during Q3 FY23 stood at 79% of total revenue as compared to 78.7% in Q3 FY22. I shall now brief you on the standalone result highlights. Revenues stood at 134.2 crores during Q3 FY23 as compared to 148.3 crores during Q3 FY22. EBITDA stood at 18.2 crores during Q3 FY23 as compared to 24.3 crores during Q3 FY22. EBITDA margin stood at 13.6% for Q3 FY23. PAT stood at 4.5 crores during Q3 FY23 as compared to 9.3 crores during Q3 FY22. PAT margin stood at 3.3%. Cash for Q3 FY23 was reported at 12.4 crores as compared to 16.5 crores during Q3 FY22. Now coming to 9-month FY23 highlights. Revenue stood at 466.2 crores in 9-month FY23 as compared to 413.2 crores during 9-month FY22, a growth of 13%. EBITDA stood at 65 crores in 9-month FY23 as compared to 68.3 crores during 9-month FY22. EBITDA margin stood at 14%. PAT stood at 21.3 crores in 9-month FY23 as compared to 27.8 crores during 9-month FY22. PAT margin stood at 4.6%. Cash PAT for 9-month FY23 was reported at 44.6 crores as compared to 47.4 crores during 9-month FY22. Our ROC and ROE stood at 12.1% and 7.7% respectively as of 31st December 2022. The growth in business has been achieved with disciplined use of capital. Our debt to equity stands at 0.55x and our long-term debt to equity stands at 0.19x. On a consolidated basis, revenue stood at 472.6 crores, EBITDA at 16.9 crores, and PAT at 25.2 crores for 9-month FY23. 69.9. Sorry. This is all from our side, and now we can open the floor for Q&A.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nirali from Unique PMS. Please go ahead.
Yeah, thank you for the opportunity. So you very clearly mentioned in the last call that we are facing demand issues in Europe and North America. But if you can qualitatively help us understand, that how are the 3 growth segments individually looking at? So home furnishing, pharma and toys. So is at least healthcare ramping as we had expected it to, or we are facing issues there too?
So Nirali, when you look at home furnishings or you look at toys, both of these are basically heavily focused on North America and European markets, where we have seen demand slow down with our customers, and which is impacting our volumes as we speak. We see, based on whatever discussions we've been having with customers, we see this continuing for the next 2 quarters and some improvement happening post that. As we move forward, we will keep you posted on what's happening. At the same time, what we are doing is we are talking to multiple customers across these segments to see how we can add newer customers and newer geographies to it. We should have some feedback on that also over the next 2 quarters in terms of the discussions which we have been having forward. Okay, Pranam, you want to answer that?
On the healthcare front, we have not seen a slowdown, to be honest. We have been more or less in line with new projects. Obviously, there's always a plus or minus 3-4 months of time period where projects can sometimes get delayed on account of either Shaily or the customer, again to do with development. But otherwise, in terms of supplies, we have not seen any drop in demand for our existing healthcare portfolio.
Okay, sir. So in FY22, on the toy side, we had done, I guess, revenue of about $7-8 million. So what will be that number for FY23?
So it will probably be around 60% of the number which you talked about.
Oh, okay, sir. And on the pen side, so we were guiding that, our own IP pens will be doing a volume of about 3 million in FY23, and that reaching to 20 million over the next 3-4 years. So any update on that? Are you confident of doing 3 million in this year?
Yes, we have done. We have already, I'd say, done 65% of that, and some orders will move on to the next year. But because there isn't like an alternate source, this order doesn't change from Shaily.
Okay, that's great to know. And we were also hoping to get some clarity in this month. You had mentioned on the last call about the overall demand or any increase that our customer wants. So did we get any clarity, or we are yet to receive further clarity on that?
So the clarity is that we don't see improvement for the next 2 quarters, unfortunately.
Okay, fine. So we'll still wait for 2 quarters to give further clarity on the other newer segments also that you mentioned.
That's right.
So we would basically update, I think, on a quarterly basis in terms of what's happening on the business front. While we are actively pursuing multiple fronts and everything, but should have a much better update to you in the quarter 4 and quarter 1.
Okay, sir. Sir, that's great. Thanks. That's it from my side. Thank you.
Thank you.
Thank you. The next question is on the line of Manish Gupta from Solidarity. Please go ahead.
Thanks for the opportunity. Are you at liberty to share 9-month numbers for healthcare for FY22 vis-a-vis FY23, so one can understand, what's the extent of impact in the other business lines?
Manish, we typically don't share individual numbers, but what we can say is when you look at 9 months FY22 and 9 months FY23, healthcare, you would see a growth on the overall numbers.
Sanjay, I'm just curious that, why do you not share the segmental breakup? Because, I just want to understand what the concern is, but because clearly the healthcare part of the business is a far more attractive part of the franchise, right? So even if you just were to split the numbers as healthcare and others, from our perspective, it gives a better sense of how the more attractive part of the franchise is evolving. So I'm just curious to understand why you would not split that number every quarter or every half year. Surely there's no competitive concern, right? Because you're not disclosing names of customers or molecules or all that.
So Manish, I think points noted. Let us. What we will do is we will have a think about this and certainly try to see if we can share this in the public domain from the next quarter.
Next quarter or next year.
Or next year. We'll certainly.
To also take the board into confidence before we do.
Yes.
Oh, okay, great. Next question is, this entire macro theme that everyone is talking about, the China plus one thing. Amit, can you talk a little bit qualitatively about now that, there's been some time evolved and you would have had BD discussions with customers. What part of this theme do you think actively would interest Shaily? My sense is, I could be totally wrong here, but my sense is the toys part of the business might actually be a lower margin, and I see you guys as a very margin-focused company. So, for example, do you really think the toys opportunity, which is a big opportunity in numbers, is something that would interest Shaily strategically?
It's a bit of a tough question. I'm going to try to answer it as it has evolved with Shaily and in terms of my thoughts. When we got into toys, we certainly evaluated the margin profile. We certainly looked at how it fits in with our existing capabilities, and there is a good fit. Existing capabilities, compliance in terms of safety, chemical compliance, sustainability, engineering, and then the sheer size of the opportunity and how quickly you can scale up the toys business. But you're absolutely right. I think the toys business is one where there is a lot of pressure on margin. So the first few products that we took on the higher end of the spectrum of toys. We did not do very simple products, but we are seeing increasing pressure on cost. And even though China is supposed to be technically more expensive on manufacturing costs, they have a lot of support when it comes to capping raw material prices. They've also set up alternate infrastructures in countries like Vietnam, or even in India for that matter. So we are seeing increasing pricing pressure on toys. We will not be making any further investments in toys until we see a portfolio of products that customer consistently buys from Shaily.
So, Manish, just to add to what Amit said, when you look at the current situation, in a lot of cases, what we are seeing is the raw material prices or the input prices which China vendors have is controlled by the government there, where there's an advantage to Chinese suppliers as compared to suppliers in India.
For example, polypropylene is controlled at, I think, $970 a ton in China, whereas what we would source it at somewhere between $1,100 and $1,200 a ton. So, there is a significant disadvantage in the input costs.
Right. So now that we've had a chance to study this a little bit more, which aspects of China Plus One do you really think are an opportunity for Shaily, and what is just big picture stuff but won't really translate into an opportunity for you?
Broadly speaking, Manish, we see very good opportunity in consumer electronics, telecom, in industrial applications, potentially appliances as well. Again, too soon to talk about anything concrete right now, and we're under confidentiality with any one of these guys that we'd be having discussions with. But we see very good opportunity and a probably a much better fit in terms of our engineering capabilities.
Okay. Next question is, Amit, there's been a lot of capex done in the last 15 to 18 months. And how do you think about that capex that you've done vis-a-vis the macro environment that we are seeing? And how do you think about capex going forward? Are you going to link it to specific opportunity, or is this that we've got to build it first and then go and get the business? So, and a related question is, can you talk a little bit about new logos that you have added in the last few quarters, and what exactly are we doing on business development, in some of these areas that you just talked about, consumer electronics, telecom? Are we adding to our team to pursue these opportunities, or is this a business where really our technical competency sells? We don't need BD, we just need these customers to visit our plants. So sorry, 2 or 3 questions rolled into one big question.
Okay. So on investments, I'm very, very clear. Going forward, capex spent on the objective is that we're going to utilize our existing infrastructure. We have very, very good infrastructure to service even the new segments that we're getting into. We might have to do some specific capex in terms of very, very specific equipment, but we're not talking about any substantial capex in molding, in injection molding, where for either servicing the existing segments or the new customers that we are targeting. On business development, we had any new logos in the last quarter. to be honest. We are in discussions with several large multinationals, including big box retailers, electronic companies. We are confident that we will be adding new logos over the next 2 to 3 quarters. Very, very confident. And what was the last question, Manish, again?
What do you do? The last question was that in order to add logos, do you need to add more BD people, or is it that we have enough of credibility in the marketplace and there's no point adding BD people? We just need to show customers our technical competency in the factory. Because I don't see I don't know if you've added BD people to go and knock on doors and showcase Shaily. Other than the Swedish major, I don't know whether we've added any big box retailer over the last couple of years. So the question is, we put this capacity out, we have technical competency, but are we investing enough in a sales team to go and take our message to the world?
We have added to our BD team with a specific focus on also increasing, in addition to the other big box retailers, also increasing business in the domestic market. So there are certain segments in which Shaily can play even in the domestic market. We see a lot of emphasis and investments happening in power infrastructure especially. So we have added specific business development folks with a focus on these segments. But you're right. A lot of our business development really happens if we can get a customer to visit us. 60 to 70% of our BD is done the day they visit us. So whether they should move forward with the Shaily or not, then it really comes down to whether you can come to a commercial agreement or not. But most of our job is done when they visit us, and that we are actively pursuing.
Okay. Last question from my side is that basis your current gross block and whatever capital work in process you have and whatever little investments you have to make, what do you think is the peak revenue capacity of the company basis current investment?
So Manish, if you were to look at our March 23 capex, including the CWIP, the revenue which the company is capable of doing will be somewhere between 2.25 to 2.5x of the total gross block.
So 2 to 2.5, so 2 to 2.5 times March 23 gross block.
Right, Manish.
Okay.
And Manish, just to go back a few questions, I think you had on the investments. So while I said that we will be very careful about where we invest and use the existing infrastructure, the only area where we make investments and look for business in the future is healthcare, is pharma. That is one area where we will need to gear up in advance so that the scale up happens in the future.
Yeah. So just a related question on this, Amit. The steel furniture investment, what percentage of the utilization are we on right now?
Manish, we are in low 30 utilizations. But what we're doing is we are in discussions with the home furnishing customer and also two or three other.
I think the question was specific to pharma.
No, home furnishing.
Oh.
If you talk about yes, Manish's question was on the steel furniture part of it. So, and we're looking at, or we are having active discussions over 2 or 3 other guys, and as Amit said, we hope to add 1 or 2 of these names in the next 2 or 3 quarters going forward.
Okay. Thank you.
Okay. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star in 1. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah, hi. So my first question is, if healthcare has grown and we were, supposed to get, pricing adjustments, if you recall your quarter 3 call, I'm surprised why has the gross margin continued to remain under pressure? Because healthcare is supposed to be a fairly high gross margin business, right?
Yes.
And where are we on the pricing increases then with the other portfolio business?
Pritesh, most of our pricing adjustments have happened during middle of the current quarter, the last quarter. So they have been factored in here. What you're seeing is basically a higher fixed cost because of the lower utilization level.
But price adjustments when you don't sell anything, you sell less.
Yes.
Is what's causing this.
No, I don't see any gross margin expansion, right? So QOQ it is flat, YOY it is down 300 basis points. So I don't understand what you are comprehending and what am I comprehending. So keep the utilization part aside, so I can understand that.
Pritesh, one difference which you need to look at is when you look at gross margin, please look at the consolidated gross margin, because till last year we were doing development in India on the healthcare front. We're now doing development in the UK. So that revenue comes directly to UK. So when you look at this, you basically need to look at it on a consolidated basis.
So even if I look at consolidated, your RM to sales is 62% in quarter 3 FY22. Your RM to sales is 64% in quarter 3 FY23. And your RM to sales is 64% in quarter 2 23. So there is no expansion between the two quarters. And YY there is a decline despite the fact that there is a growth in healthcare. And you say that you have taken price increases between quarter 2 and quarter 3. So ideally between quarter 2 and quarter 3 there has to be a margin expansion, right? The gross margin.
But there is, just a second, Pritesh.
Because there have been, when you look at the, what you need to look, so if you were to compare Q1 to Q3, you would have seen improvements happening on the
but your Q1. So you say if the price increases between Q2 to Q3, then I will see from Q1 to Q2 and then from Q2 to Q3. I cannot see from Q1 straight to Q3, no sir?
I agree. So there is a business mix change also which is happening around.
But sir, healthcare has grown and everything else has not grown. So business mix should have improved.
No, so one thing is healthcare is growth. Okay, healthcare is growth. It's not that healthcare is not growing.
So then the gross margin should improve.
The gross margin is more or less at the same level, is what I agree with you, and that's basically because of a lower utilization level. Because when you are at lower utilization level, you basically end up having a little higher rejection or startup scrap or something.
Okay, I'll take this separately. I still cannot comprehend. So now where are we on? See, a lot of our traction depends on the progress in pharma. A lot of the traction GM also depends on the progress in pharma. Right. Where are we now? And is there any changes for our outlook for FY24 in pharma by any chance?
Pritesh, can you repeat the question, please?
You think, is there a change in the outlook for FY24 in pharma?
No.
So will we see the margin expansion for sure happening next year? Because this year you had first 3 quarters of higher RM, which is not specific to you, it's specific to a lot of companies. And you should be getting your price increases to flow into your P&L. there is a straight, I can see about 200 to 300 basis point at least, because you are at 60% RM to sales. Today you are at about 63, 64%. So there is a 3-4% there, plus there is a pharma movement to happen. Will we see gross margin expansion, or there will be something else to play in and we need to understand that?
You will see gross margin expansion as we go forward. And as revenue improves, you would also see.
Sir, that I understand. I understand operating leverage part, because if you are operating at 50% capacity utilization, I understand the operating leverage part. Where I am unable to still comprehend is the GM part.
So, see, on the GM part, what also needs to be factored in is when volumes are down, my logistics costs on my raw material and everything go up, which gets factored onto my overall raw material cost.
Okay. Okay, we started the year with a 700 crore revenue. What do you think you will end the year now at? And where are the slippages? So quarter one was 175. I think when we were at quarter one, we did 175 into 4, so we were at 700. Quarter two becomes 161, quarter three becomes 136. So if you could give the bridge between quarter one and quarter three for this 30-40 crore reduction in business, where are the slippages and how do we see it ending this year?
So the slippages are basically on home furnishings, exports, toys, mainly on that account.
Okay.
And carbon steel. So if you were to look at it, these are 4
Major
drops where there have been drops. I would say quarter 4 will be similar to quarter 3. Somewhere in that region.
But sir, your quarter 2 call also did not tend to say that. Suddenly in quarter 3 you are saying.
No, on the quarter 2, I believe I did say on the quarter 2 call that we will come back with an update, but we're not seeing a very good picture on demand. We did not expect a very large drop, but that is what's happened.
Okay. So now, and how do we see now the FY24, especially on the pharma side of the business? What kind of growth do we see?
On the pharma side? On the pharma side?
Yeah.
On the pharma side, we are looking at somewhere between 25 and 35% growth. And with that growth, you will obviously see margin expansion.
And where are we on the capex now? So the last capex that we announced was for pharma, and I'm hoping, that was for pharma. So I think about 100 crores, right?
Yes.
And that's the only capex. And that's the only capex which is ongoing, right?
Yes.
Where are we? How much have we spent? And what is when it commercializes?
So the pharma capex would be completed by quarter 1 FY24.
And how much have we spent so far?
We would have spent about 60 crores till date.
And because we have enough capacity elsewhere, because we are running at 50-60% capacity utilization,
right?
We won't get into a capex unless we add a logo which needs some specific capex. Yeah.
As Amit said, Pritesh, we will be looking at sweating our assets. The pharma capex is a specific capex which was required to be done. Because that's in clean room and you need that capex.
Yeah, I understand that.
Pritesh, just to add to what Sanjay Bhai said, when we're talking to the other big box retailers, their business models are different than the home furnishing major that we work with. A lot of these will buy off-the-shelf kind of product or something that you specifically design. So there will be some investment required, but we will not make any investment in infrastructure. It will be tooling which will be done. Yes.
Not in machines. Not in physical infra.
No, right. That's correct.
Okay. So basically for the next 4 quarters, 4 to 6 quarters, because you're at 50% capacity utilization, we might not hear any CapEx announcement from your side.
That is what we foresee right now. The only way they can be, if we were to even think about it, would be if there's a substantial, sizable opportunity which requires a greenfield. But otherwise, for the next 4 to 6 quarters, we're not looking at any investments.
And what will be your maintenance capex?
Pritesh, that will be nominal. I would say around 2 to 3 crores. A lot of our assets are new, so we do not need maintenance capex there. Some of the old capex which we have, it will not be substantial. It will be about 2 to 3 crores.
Okay. And lastly, sir, when you said 30% utilization in metal furniture, so has the utilization come down by any chance?
Yes.
And can you highlight the reason?
Demand drop. There's steel furniture, if the customer has seen a much higher demand drop than the plastic articles.
Okay. And has the asset stabilized with respect to the coating line and all, where you had some challenges?
Yes.
That has stabilized, and post that we have already, as I mentioned earlier, we have started discussions with 3-4 other big box retailers to see how we can expand the customer base.
So the production guy which moved from the auto industry to your company, he is able to manage the asset well for you now, at least from the operations part.
Because the production guy is actually ex-Godrej. And yeah, he's doing a very good job.
Okay. Thank you very much, and all the best to you, sir.
Thanks for this. Thank you.
Yeah.
Thank you. The next question is on the line of Aman Vij from Astot Investment Management. Please go ahead.
Yeah, good morning, sir. My first question is on the pen side. So we had talked about there was a launch planned in January. So is that launch happen or is it delayed? And when is it expected now?
So we have, because it's a commercial order, we have gone ahead with the production and are dispatching it to our customer. The customer is awaiting approval any day now. Don't have a further update.
Sure, sir. And on the pen side, so we have a target of 3 million and plus minus something. We'll achieve that for this year. And what is our target for FY24, sir?
Can you repeat that question, please? And maybe a little louder. I'm finding it difficult to hear you.
Yeah. On the pens side, we had a target of 3 million for this year, and we'll achieve close to that. What is our target for FY24?
It's going to be roughly 35% higher.
Sure. So you are talking about most of the growth that you are seeing in pharma, you've guided similar growth will come from this pens only.
Yeah. See, there are pens, and in addition to pens, there's also auto injectors that we have developed, and we are making the first supplies in June of 23. So we will see some additional orders for both products in FY24.
Sure, sir. Then coming on to the home furnishing side, so we were expecting to reach and become the third largest supplier to our one of the main customers. So given the slowdown and all those things, when do we expect to achieve that target of becoming the third largest supplier to them?
The slowdown has happened for the entire supply. I actually don't know where our ranking stands today. It would probably be third or fourth anyways. But if it's not, we would certainly, I'm not as, in terms of our own business, whether we become 3 or 4 is not so important, is how much growth we see in the upcoming year. So we've already said that the first 2 quarters, we're not, we expect the current scenario to continue, and hopefully we see improvement post that. We track this, we have this discussion with the customer on almost a daily or, every other day kind of basis. So it's something that we are tracking very closely.
So in terms of utilization, where are we currently in this home furnishing? And for next year, do you see a gradual improvement or?
Aman, we do not report individual utilization levels, so I would not be able to talk about it. We have talked about overall utilization levels be at about 40%. As we speak, we would basically update you guys on how the utilization levels will improve over the next 2 quarters, whenever we have these quarterly calls.
Sanjay sir, just wanted to understand the impact on the slowdown. So is it like 10-20%? Is it much more? I am not interested in exact numbers of utilization, but just to gauge the impact of slowdown on the home furnishing side.
So home furnishing, 2 of our major markets have been North America and Europe, where there has been fairly decent contraction of demand which has come in, which is why the slowdown which we are talking about is happening. As we speak, I think whatever stocks are there in the system and everything should get liquidated over some point of time, and over the next 2 quarters we should basically get back to normal demand. But I think a lot of it will depend on how things pan out in these 2 geographies.
So, sir, Russia had a lot of issues. They closed their center in Russia. So we didn't get any benefit of that. Did we lose any business because of that issue?
Yeah, so we were making some shipments to Russia. So those shipments that came down. So, not very much. But yeah, for the customer, Russia was a pretty large market and a pretty fast-growing market. So yeah, it made impact on their operation.
Sure, sir. Sir, in the initial part of the commentary, sir talked about, Amit talked about that we might enter into newer areas like consumer electronics and telecom. So if you can talk a little bit more about it, will it be plastics only? Will we try to merge our capabilities in plastics and steel or any other new material? If you can talk briefly about these new things which we might try.
Basically, so we will not be able to talk a lot about it in terms of names, logos, things like that. But yeah, it will basically be to do something around plastics, because as Amit mentioned earlier, we will be looking at utilizing the capacities which we have created, and the capacities which we have created are in plastic.
Okay, but these will be totally new customers and new segments?
Sorry,
these will be new customers and new segments, or the current ones only in these 2 sectors?
New customers and newer segments, both, and new geographies also.
Sure, sir. On the toy side, you have talked about a stark slowdown, almost I think 30 to 40% fall in our sales. So has it been all across? We have 2-3 clients, or is it specific to one client? Are we taking any steps to, because we have very good SKUs and we were trying to increase our business over a period of time, but I understand slowdown is happening, but what are the steps as a company we are taking? And if you can also talk about, is it all our customers, or is it one particular customer that we are seeing this big drop?
So Aman, we have 2 customers on board. We are in discussions with both these customers to see how we can scale up and add more products and everything. Currently, the way the business is, and with over a drop in volumes, basically the customers would be looking at utilizing existing infrastructure with suppliers in China and everything, which is where we are seeing demand good, because the drop with some of their Chinese vendors have been very, very large. But at the same time, we continue to engage with them to see how we can add newer products and newer ranges which we can supply to them. We would have, I think we should be able to see some movement on that as we speak over the next 2 quarters. And
Sure, sir. Final question is on the utilization side. So, what kind of utilization are we targeting for next year, and when do we expect the full utilization of whatever the capex we are doing till, say, March 2023?
We would probably refrain from answering that question right now till we get further clarity. So let's wait over the next 2 quarters and we would be able to give that number out.
And we'll give you an update every quarter on what we see happening.
Sure, sir. Final thing, sorry. Have we lost any kind of market share in any of our businesses like home furnishing?
No.
Okay, sure. Thank you. These are the questions from us.
Thank you. The next question is on the line of Ritesh Shah from Investec India. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, first, very basic question. You did indicate a nice example of polypropylene $900 versus $1,100. For us, here, 60% of sales stands at raw mat. Just wanted to understand, are there any other elements, commodities where you see such stark differential on India procurement cost versus what's there in China?
So, Ritesh, this is one where we are very much aware of, but I think there have been multiple countries where this sort of input price control has been there with suppliers in China. So that's where we have been seeing this across multiple categories. Now, we do not know what's the extent of the difference between a lot of these, but in some cases we know that. So Amit mentioned one of them.
Right. I'm just trying to understand from the management's thought process standpoint, if it is a risk which we have just picked up, what is the risk mitigation strategy for the company going forward? So on the overall basket that we are looking at, 60% is a sizable number. So just trying to get a sense, like, is there a risk mitigation strategy in place when it comes to commodity sourcing and whether it is on import parity basis in India versus Chinese competition?
So I don't think this is going to be a long-term sustainable pricing strategy which will be there. So this is probably there to just for a short-term purpose, and we expect that this will get corrected over the next 1 or 2 quarters or something. You want to add up anything?
Yeah. See, Ritesh, just to add to that, we need to. There are obviously certain advantages that India has, whether it is logistics cost or our manufacturing cost. So we need to take advantage of that. On an overall landed cost to any country, typically North America, we fare better. In Europe, with the additional advantage that they currently have on raw material, it's very, very close. We're higher in some cases and lower in a few. We need to see how we can optimize this and still move forward. One of the key things here is that where there is a true partnership with the customer, there is an impact, but a less of an impact because you work on a sustainable long-term pricing business model. Where relationships are new or the product is very, very price sensitive and the customer is under tremendous margin pressure themselves, it becomes difficult to sustain. So if there is a short-term advantage, will they take it? Certainly. They certainly will.
Sure. Second was on, we were looking to appoint a CEO. Has there been any progress on that front?
I think given where the margin stands right now in the utilization, we were actively pursuing it until the end of Q3, but we have put a hold on it for now. So we will reevaluate this at the end of Q1 FY24.
Sure. First question is basically, I think what we have seen is slippages on both revenues as well as gross EBITDA margins from the last 3 quarters. I think it was well alluded in the prior part of the call. What is it that we are doing about it? I understand, appreciate it as a not because of external variables. But chasing new segments, is that the right thing to do? How are we revisiting the strategy? I think on the pharma side, you did detail that you're very confident. But when it comes to specifically home furnishing and garment space,
Ritesh, your voice is breaking in between. I think if you're on a hands-free or something, you'll probably...
right. Am I audible, Sanjay bhai?
It's a little better, Ritesh.
Yep. So my question was, basically, if you look at the last 3 quarters, there has been slippage on both revenue growth as well as gross EBITDA level margins. I appreciate...
Mr. Ritesh, so there's a lot of background disturbance from your line.
I'll join back the queue.
Thank you.
Yep.
The next question is from the line of Adhiraj Singh from Amacus Capital Partners. Please go ahead.
Hello. Am I audible?
Yeah. Yeah, you're audible.
Just wanted to check what's the outlook for the toys business in FY24 that we have?
So, Dheeraj, we are pursuing opportunities there, and we will let you guys know by end of quarter 4 and early quarter 1 in terms of how we are going ahead.
Okay. So I think right now we have 2 clients and it will largely be exports. So are we even looking at domestic clients per se?
Yes, we will be looking at domestic clients also.
Okay, and just last one thing, how much capex has been done in the toys business and how much asset turnover do we expect there?
So the total capex which we have done is about somewhere between 20 to 25 crores in terms of specific capex which has been done, but that capex is fungible across our business segments. So.
Okay, and roughly what asset turnovers do we look at in this business?
We typically don't, again, give out individual asset turns, but probably be higher. I don't want to put that out.
Okay. That's from my side. Thank you so much.
Thank you.
Thank you.
The next question is from the line of Manjeet Bavaria from Solidarity Investment Managers. Please go ahead.
Thanks for taking my questions. Am I audible?
Yeah, Manjeet. Go ahead.
Okay. I had 3 questions for Amit. Amit, the first question was, a few years back we had discussed that our largest customer is looking to consolidate their supplier base globally. And their preferred suppliers will keep gaining market share or wallet share within their ecosystem. So has this hypothesis played out over the last 4 or 5 years, or that's not really played out as expected?
I mean, we saw good growth last year from that customer. We put up a new facility for them. We've talked about this in the past. So from whether the hypothesis has played out, they've consolidated. Hypothesis has played out, but there isn't demand right now. So overall, have we seen the growth that we were anticipating? Absolutely not.
Got it. Amit, the second question was, in the products which we are supplying to our largest customer today, right? Just the products we are already supplying, what would our share be in their global, share which they have?
It would vary from product category to product category, but I can give you a broad range. It would be everything from 30% to as high as 90, 100%.
Got it. And for categories where, let's say, we are below 50% share, if you want to increase our share, is this business bid out and do we get to bid for all these opportunities, or it's more of a one-on-one negotiation where we need to go and convince them to give us that business? Or it's a tender or a bid which they remove and then we can just participate in it?
I think 2 things happen, Manjeet. One is that when the customer makes a decision to have more than 2 or 3 sources for a particular product category, that product category has a very high service level requirement. B, probably when they create 4 or 5 capacities globally, they want to ensure that they never run dry. Then allocation of regions or percentage of volume depends on how competitive one is on landed price. So it's not just purchase price, but how competitive one is landed in any of the markets that they serve. once a market has been allocated, it doesn't really go away unless you fail to supply, unless you're seeking a enormous price increase, which is outside of what the raw material market movement is. So markets don't typically go away. The problem right now is that each of their suppliers would be suffering like us. So it's not that they've taken business away from us and given it to someone else. It's that they've tried to balance out as much as possible, but there is just an significant drop in demand overall.
This was very helpful. One last question, Amit. In terms of adding more logos, on peer set of our largest customer, right? I'm sure we would have tried some of that, but we have not really seen massive scale up anywhere over there. And given our relationship with this largest customer, our technical capabilities, it's just surprising why we have not been been able to scale up more aggressively with some other peers. So some thoughts over that would be very helpful.
Maybe I'll give you a few examples. In the past, I don't remember the exact year now, but I think maybe 8 quarters ago or 9 or 12 quarters ago, we did add a customer. It was a large German supermarket. We've given the name, right? Yeah. We had added Lidl, and we had certainly made some supply. But the business model is very different from that of our current home furnishings major. See, they have buy cycles. So you make the investment in capacity or in tooling. A, you're not given any guarantees on whether they will buy or not. B, they have cycles. So they will buy twice a year. You will need to produce in advance and stock it, and then ship everything in a matter of two weeks. So as a business, it becomes very difficult to manage the supply chain, manage the manufacturing, unless you get into a constant cycle of doing this over and over again. And we've not been able to crack that cycle because excuse me, we also don't have off-the-shelf products to offer. We are a OE, so we do contract manufacturing for our customers. Having said that, given the current pressure we're under, we did decide that, look, let's look at a sizable opportunity, and if we need to then have that offering off the shelf, we'll develop it. So that's what we're trying to do right now. But we need business or a model where there is some consistency in ordering and supply. If you give us 2 large orders a year, it becomes very difficult to manage. And then these, they give you a production schedule, not so much an order. So if that production schedule changes, drops, and you've already produced the parts, then you're kind of, you're stuck with inventory.
So, Amit, I hear you. So what Sorry, Amit, so I hear you. What you're trying to say is with the largest customer, it's more of a partnership business. Here, it's more opportunistic offtake from, these customers. So if that understanding is correct, is it fair to assume that lot of our growth, because of all this, China plus one or global players, shifting to other countries, is not actually a target addressable market for us, because we don't really want to work with low quality business partnerships, and which means we'll have to start selling something more like a healthcare product. Is that a fair assumption that the set of competency we have in our largest customer is not so fungible across many of these large other customers globally, just from a quality of business perspective?
I think that's going to one end of the spectrum. There are many big box retailers. Everybody work on a slightly different model. I gave you an example of one of the largest in the world. But having said that, there are many out there who have white label products where you can have consistency in supply. And, we're talking to most of them today, trying to explore a business model that suits us or is very close to what we're already doing.
Okay, this was helpful. Thank you so much.
Thank you. Thanks, Majid.
Thank you. The next question is from the line of Ritesh Shah from Investec India. Please go ahead.
Yeah, hi, Sanjay bhai. Am I audible?
Yeah, Ritesh.
Yep. Hi. I had one basic question. The sort of commercial contract that we get in when we have in past incurred tooling capex, To my understanding, it did have certain volume commitments. Given the scenario we are in, because of external factors, volumes are actually slow. So are we getting, basically, does something accrue to us on back of the commercial contract that we had in place?
Yes. So if those volumes don't happen in that time frame, the time frame does get extended.
Okay, but sir, then the NPV will change, right? If it's the same quantum over a longer duration, then it doesn't make economic sense from the company standpoint. So how does that risk get captured?
That also gets adjusted. In most of these cases, the investment is made by getting an advance from the customer. So technically, the NPV will not change.
Okay. So, sir, can you highlight, given the volume slippages which are there because of the external variables, when do we see this impact to come in for any large contract that you have? Can this be expected in first half of next year based on the duration of contracts that you have?
Sorry, Ritesh, I did not understand. So,
Sanjay bhai, you indicated like these are fixed duration contracts, right? So the volume uptake should have happened over 2 years or say 18 months. Now, I don't know the start date and the end date for this particular contract. Given the reporting that we have, a lot is attributable to the external slowdown. But I think the company has this volume offtake arrangement in place. So I just wanted to understand when do we see this benefit on the margins, given you might have different contracts for different SKUs. But is there a number that we have wherein we can actually expect a benefit with a lag, even if the volumes do not come through, say, in a bad case scenario, say 2 quarters out or 3 quarters out?
So Ritesh, margin improvement can happen if your volumes pick up, right? So there are two things here. When you talk about margins, one is the raw material pass-through, and second is volumes pick up. For a business which we are doing right now, at an overall utilization levels of 40%, you will not get that sort of margins because these businesses are structured in a way where you basically run at very high capacity. And that's where you basically generate margins which you are able to do. When I meant if it's a 2-year contract, and if we don't get those volumes in 2 years, that contract gets extended for the next 6 months, 1 year, still that recovery does not happen. Or there could be an upfront payment which is made by the customer. Extraordinary cost, yes. In case those volumes are not going to come back.
Correct. So Sanjay, my question is specifically, you gave an example of 2 years. Given we have a significant revenue which is concentrated with a furnishing major, last 3 quarters have been slow for some reason, and hence, I'm just trying to gauge when does this 2-year tenure hit, wherein we will see some additional tailwinds because of this particular variable helping us.
Ritesh, that's what I'm saying. You will not see tailwind.
Are you asking whether we enforce the contract as in, demand that the money be paid?
Right. I'm saying if the volumes don't come through, the money has to still come in. So when should we look at that scenario, or has it not got triggered? When do you expect that to trigger? Assuming internally, if I was in your place, I'll do a bad case forecasting, and then I'll have to bake those numbers into my P&L.
So, if I'm understanding your question right, even if it gets back-ended or something, it will not make an impact on our margin, is the way I would put it out.
Okay, but then what's the essence of a commercial?
We're being very specific on tooling.
Yes, yeah.
Okay, probably. Sanjay, I'll call you separately for this to understand it better.
Fair enough. Yeah, that's okay. No problem. Thanks.
Yep. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Amit Sanghvi for his closing comments.
Thank you, everyone, for joining the call. We hope that we've been able to answer your questions adequately. For any further information, I request that you get in touch with SGA, our investor relations advisors. Thank you very much and have a nice day.
Thank you. Ladies and gentlemen, on behalf of Shaily Engineering Plastics Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.